Hi, thanks for listening and following along. This is just a update video. I'm going to try to be as clear and quick and concise. I don't want it to be too long, but I'm just going to add some additional color to some of the updates that you've seen me make on Twitter if you follow me there, or on StockTwits if you follow me there. Throughout the year, I initially came out with a forecast in January on Fed hiking cycle, and this was before the January 28th meeting where the Fed abruptly changed policy and went in a completely less hawkish direction. So initially when the video came out, I anticipated that we would see one rate hike, and that would happen in the month of May. That did not take place, and it was also dependent on strength in the labor market, strength in the weakness in the first quarter of the GDP, which also didn't happen in the way that I was anticipating that it would happen. But I also felt that there would be a surprise production cut from the Saudis and Russia, and an agreement to maybe extend that to maybe 2 million barrels a day. That would have a positive impact on world oil energy prices and would offset some of the growth in the U.S. Permian Basin. That didn't happen. All these things would have had an impact on inflation expectations, along with the tightening of the labor market, which would have likely increased wages if you didn't have that gigantic jump in productivity. And also the tariffs, I assumed, would pass on additional costs, but that was probably offset by the strength of the dollar in the first quarter. So having said that, and having had the Fed adjust, I then made a video that indicated I anticipated a lower for longer, and that seems to have played out for the first quarter for the first quarter and the second quarter of this year. So I reiterate my GDP outlook. The first quarter GDP, if you strip out inventory and the positive bump in net exports, it closely reflects my prediction of 1% to 1.5%. I think the inventory build, net exports, and relatively weak consumption will weigh on GDP in the second quarter. I'm also sticking to 2.8% real GDP forecast for the second quarter, but I expect lower third and fourth quarter real GDP to be more adversely impacted from the inventory build, slower residential investment, less fiscal expansion, and continued drag from the strength of the US dollar. I don't think even with the rate cut that we're going to be able to offset some of the extremely low potential growth rates in both the European Union and also the Japanese economy at this point in time. I do expect the drag from the US dollar will subside at some point, especially once clear communication from the Federal Reserve emerges indicating a September 2019 25 basis point rate cut and the start of QE light in October. So if you've been following me on some of the, like I said, Reddit or stock tweets, you noticed that I probably made a lot of these updates in March and consistently stuck with these updates that we would probably enter a cycle of policy easing. So typically what normally has happened historically with the Federal Reserve is that you've had policy hiking when the economy has grown above potential growth rates, and then you've had policy easing when the economy has grown below potential growth rates. This is a little bit interesting in the sense that an insurance rate cut is something that's preemptive, and it's not necessarily data dependent like the Fed has been and has consistently been in terms of utilizing data dependency as well as forward guidance as policy tools in their toolkit to communicate with market participants over the course of the last decade during this current fiscal, I'm sorry, not fiscal, but current economic expansion. So that's one of the interesting things. So if the Fed were actually to appease the market, I think it may actually have some credibility issues because it's not only appeasing the market, but it's also appeasing the executive branch, and it's sort of kind of shifting the policy communication tools and muddling the policy communication channels that they would like to use to persuade markets in the way that they see the outlook for the remainder of the year. But I think again, the market is moving along with the growing conviction that I have for it's definitely going to be a lower for longer interest rate environment, which is going to be continued and very supportive for credit spreads as well as duration. The next FOMC meeting will be held on July 30th and 31st, which is the end of this month. Then the next one is September. I've pushed my 25 basis point cut to September. I think that's the most likely point that it's going to happen. There's as of right now, the September based Fed futures as of today are about 57% for a 25 basis point cut, and this is assuming that there's a 73% chance in July, which is the end of this month, for the first cut. So that's including about 50 basis points of easing over the next two meetings. I think there's only going to be a cut at the September meeting. I think if the economy were to abruptly decelerate once they implement the QE light in October, you could see an additional cut in December. So that would be a total, in my book, of about 50 basis points of easing. And if you look back to some of the earlier videos I did, I had about 50 basis points in my worst case scenario. Or I had about 25 basis points in my worst case scenario with a very gigantic 50 basis point cut at the January meeting in 2020. So the market's definitely well ahead of that. So if I had to do a rate-based case, I would say 2 more cuts in 2019 at most, leaving the target federal funds rate at 175 basis points to 200 basis points at the end of 2019. I think the 10-year Treasury, and I'm going to go out on a limb here and take a very aggressive approach here. I think if we are in a situation where GDP substantially slows below trend, the 10-year Treasury could see basically 155 basis points at 2019 year end versus where the consensus estimate is, which is 265 basis points. So I see a yield of a 1.55 versus consensus estimate of 2.65% at this point in time. Technicals could drive some of that, which are mainly tied to the video that I did on the twin deficit. So you have a lot of Treasury issuance coming out, and you also have a relatively strong U.S. consumer, which is the engine of growth right now. So you have those twin deficits that could actually expand in the second and third quarter. And those are structural issues as well, tied to some of those, which are the structural issues related to technology, which is advanced at a rapid rate, lowering prices for a lot of different things. And then you have the slow productivity growth, and you also have the demographic issue. So these are all issues that will likely continue to compress term premia for the rest of the year, which could act as an anchor on the 10-year Treasury and longer duration yields further out, so the 10-year, 15, 25, and 30-year. So position right now for the UST curve, steepening temporarily into the cuts, but flattening and inverting closer to year end. The Fed's balance sheet unwind will reverse after September 2019 meeting and will become a material driver of yields in the near term. That's sort of my base case right now for the interest rate and interest yield market. Like I said, credit spreads are still favorable. Selling convexity back into the market is still favorable. There doesn't seem to be a large increase in realized volatility, although when I go into my forecast for the equity market, I think that's going to change a little bit toward the end of this month. And I'm going to go out on another limb here and say that I'm sticking to the exact same equity forecast that I had for 2019. I think earnings per share are going to be 166.86 for the S&P 500. I think that's a growth rate of about 3%, dividend yield about 2.7%, 2.2%. I'm sorry, dividend yield of about 2%, and the earnings yield will be about 5.7% to as much as 6.5%. So you'll probably see multiple expansion, which is going to be driven again by the twin deficit and the fact that capital has to come into the U.S. to finance that. So I see an S&P return this year of about 4 to 6%, which means that we're probably going to have a big sell-off and a mean reversion in terms of realized volatility at some point. I think it's very likely to happen at the very end of this month, because I don't think the Fed is going to follow through and cut rates. They may do it, they may not. I think well, maybe they do, maybe they don't. I don't know what they're going to do. But I'm right now assuming that they're probably not going to do that, and I think that could probably upset the market temporarily. That could lead to a temporary sell-off, but then you have to factor in the fact that they're going to set up the September meeting, and then they're setting up QE light. All these things actually will reduce or should have a suppressing effect on realized volatility going into the second half of the year, despite slowdown in realized GDP, or slowdown in real GDP. So I'm still looking at the S&P forecast price range to hit that high of 3,000, points. I think we could get as high as 3,100 because once they cut rates, if they do decide to do 75 basis points worth of cuts this year, that immediately changes the DCF and discounting cash flows that you have to use to actually value the equity. So that should push risk assets up. The other issue is that when the Fed starts to cut rates, it influences other central banks to expand monetary policy as well and become more expansionary and more accommodative. So yields will fall all around yields will continue to fall all around the world, which will lead the U.S. equity market with a very favorable yield. And again, we have about $30 to $50 billion worth of twin deficit that has to be financed each year, each month. And those foreign financing flows tend to go directly into the portfolio channel, and that means that it's going into the debt market in the U.S., financing lower yields and higher bond prices, but it's also going into the risk asset area because it's going in unhedged, and it's pushing up equity valuations because you're still getting 5.7% to 5.5% on the S&P 500 if you reverse the earnings yield on that and compare it to what you're going to get. The difference between the earnings yield on the equity market is going to consistently widen actually versus treasuries as long as we have continued flow. So the other issue is if you were to hypothetically look at that and say, okay, well, if the market, if you assume forward P on 2019 of 3,000, you're looking at about 18 times earnings. If it goes to 3,100, you're looking at about 18.5. If it goes to 3,200, you're looking at about 19 times earnings. Now, if you also assume that in 2020 we see about 5% growth on earnings per share, you're looking at about 17 times at 3,000. You're looking at 17.7 times at 3,100, and you're looking at 18.2 times at 3,200 from a forward PE. And then you would, if you factor in 5% growth plus 2% again in dividend yield, you're looking at about 7% growth in 2020 for the equity for the S&P 500. So I think you get 4 to 6% this year, and then possibly you can get another maybe 7 to 8% next year, depending on what happens in the market. Again, I'm still making the assumption that, and I'll probably do a separate video just to add this in there, that I think the last week of July and the first 2 weeks of August, we're going to see an equity market sell-off, and we're going to have a mean reversion back to higher realized volatility temporarily until the market comes to its senses and it gets angry about the Fed hiking rates. I'm sorry, not hiking rates, but lowering rates, not lowering rates at the July meeting. And so from the equity standpoint, just saying this, given the strength of the U.S. dollar and a slowing trend in the rest of the larger advanced economies, the first quarter multiple expansion will likely continue into the second quarter. This is being driven by capital inflows into the portfolio channel. Public and private foreign savings are needed to finance near $30 to $50 billion a month. The headwinds in the base case scenario have not changed materially. I still see margin compression in the second half of the year. This is driven by slowing revenue growth, tightness in the labor market, rising real wages, low inflation, and productivity capped near 2%. So if we get into a situation where productivity runs at a higher rate than realized potential growth, we're probably going to be close to the very end of the cycle, because that typically leads to job loss. So when the minute you see productivity growing at a faster rate than potential growth rates, you should get a little bit worried, because that's going to have a negative effect, and it's also going to have a negative effect on disposable income and all those other things, and real wages in general. So the real wages that were being enjoyed in terms of the growth of real wages. These factors will continue to put pressure on margins in coming quarters. Although I do think we will see, and I keep reiterating this, a September rate cut. Given there's no cut from production from the Saudis so far, that didn't happen in April. So I backed off that as a main catalyst, as I said earlier at the very beginning of this, for the first hike in May. Having said that, the other issue that I want to kind of touch on really quickly is the fall in low expectations and inflation expectations becoming unanchored. If there is a fall in inflation expectations, and you assume that the Federal Reserve is going to aggressively cut rates in 2019, that could automatically lead to a fall in aggregate demand. Consumers may start to delay purchases, like I said earlier, waiting for lower prices in the future. Firms may reduce investment, preferring to wait for lower interest rates. This could result in Q3 and Q4 reductions in consumptions and aggregate demand. Like I said a number of times, at some point the U.S. consumer, being the engine of growth, is overstretched and has to make the adjustment because the U.S. is a deficit country. And just the way that the global economy works, a lot of these things are outside of the Fed's ability to control. So the Fed can't control low potential growth rates due to demographic changes and structural changes in the European Union or the Japanese economy, as well as the Fed can't control the shift in the structure of the Chinese economy, going from a fixed-led investment-oriented economy that's growing at a very, very rapid rate to a more consumption-driven economy, which is going to have to cut taxes and raise domestic demand. So there's a lot of things that have to happen that are outside of the Fed's control. So to orchestrate a flawless soft landing is almost nearly impossible at this point, because you would have to rely on the U.S. Treasury working with the finance minister in Germany to increase fiscal spending in Germany substantially and cut taxes in any of the European surplus countries to do that, to increase domestic demand in their countries. But you'd also have to have the Chinese economy somehow flawlessly make this transition rapidly and quickly over to a consumption-led economy without having any abrupt slowdowns, which probably doesn't seem very likely given their debt position. So there's a number of things that are just really, really far outside of the control of the Federal Reserve, even in cutting rates into a slowing economy. So there are some benefits to doing this. Like there's probably some capital, like I said earlier, that in some of the earlier videos, that will go over to the emerging markets because there's going to be growth in interest rate differentials that are favorable. And if the dollar is able to make that adjustment, but if you have some of the geopolitical issues taking place, the dollar becomes another safe haven, and you get a situation in which the dollar has to play the safe haven role, and you get capital inflows coming back into the U.S. economy that are basically attracted to the high quality liquid assets that the U.S. has and the safety of being in the large market and U.S. treasuries. So there are a lot of issues that could actually really continue to leave the dollar at a lofty price point relative to some of our trading partners through the course of the year. Having said that, like I said, I wanted to keep this very short and concise, so I don't want to go on any further, but I think there are a lot of trades that people could probably make that would be advantageous. I went through earlier, some of the swaption trades are probably still going to be advantageous if you assume that we still have about 80 basis points of, or maybe 85 basis points of 10-year Treasury yields falling further. You may be able to put on some of those trades where you're either buying a receiver swap, or you're selling a payer swaption, and then if you're selling a payer swaption, you're just collecting the income on it. Buying the receiver swaption, you're obviously long volatility in the sense that you're anticipating that rates are going to continue to further decline throughout the year. There are obviously some other interest rate sensitive trades that could make money. There's some option trades that probably will make a lot of money if you're focused on buying premium. That's probably going to work, assuming that volatility is able to mean revert a little bit higher over the next couple of weeks. But I'm a little bit unsure as to how high volatility can get given the QE light in October. That seems a little bit new, because that is a little bit different than previous end of economic cycles where you didn't have the Fed actually expanding the balance sheet immediately and actually communicating with the market immediately going into a recession that they're going to actually expand the balance sheet. And then all other central banks are actually doing the same thing in tandem. And then you also have the possibility that you have fiscal expansion also happening all at the same time. So there is a possibility that all this, you could get a relatively V-shaped recession in 2020. Which could be very likely given the fact that the global imbalances are not as stretched as they were in 2007. The U.S. had about a 6% current account deficit. The U.S. only has about a 2.5% current account deficit at this point in time. So the adjustment that the U.S. has to make is relatively small. I will do a video on the international investment position, because I think that's a very big focal point given the U.S. elections and the fact that the mandatory spending and the Social Security Trust Fund is actually going to be dipped into next year at the end of the fiscal budget the following October. And I think that's a really vitally important subject matter for investments in general, and also just for the general conversation. And then I'll also get into the international investment position of the Chinese, because the international investment of the U.S. and the Chinese are going to be very critically important over the next 5 years. and it's going to have an effect on financing because the U.S., as we know, we don't save a lot, and we haven't implemented things that would allow us to save a lot because we consume a lot, and we're still in a position where we can consume a lot. But if the Chinese are willing to take on more consumption, then we could possibly be in a position where we could actually lower our level of consumption, not have such a negative impact on the global economy. So there are a lot of videos that I come out with over the course of the next couple of days, but I just wanted to make this quick video just as a quick update on the forecast for the remainder of the year. All right, and if you enjoy it, appreciate it. Thanks for listening, and I should have some more later. Thanks.